Okay, this is session 2 of our new trading course, and this is the initial rendering of this course, and therefore the initial rendering of session 2. I want to start, I thought about this actually right before I logged on. I was just sort of sitting here collecting my thoughts, and I looked up, and I had this chart on my screen. And I know some of you can look at this chart and immediately answer these questions, and I know some of you can't. And the goal, one of the goals in this course is right here. At the end of this course, I want every single one of you, if I pull up a chart, every single one of you should pretty much have the same answers to these questions. And I don't think that you can say that with any other type of discretionary methodology. I guarantee you Troy would, if Troy and I were to take this and annotate it, our annotations on this would be identical. Now, how we might trade it might be a little bit different, but the information that we would derive from this chart that's on this chart, we would view the same way. So while this is a discretionary methodology, it is unique in that it is incredibly consistent and robust. And the other thing that's unique about this, guys, is that, really, ultimately, all you need to trade is this. It's a bar chart. Think about that. And I promise you, by the end, well, that is my goal. I know for a fact that the majority of our clients that have been with us for a few months can look at this chart and could label it just as well as I can, or Troy can, or anybody else. So let me just sort of go through this exercise. What is the condition of this market, guys? It's up. I mean, as of the close tonight, this market is developing higher in all time frames, in all degrees of time, all of them. Now, this is a 120-minute chart, so there's enough information on this chart to trade any time frame you want to trade, from a long-term, intermediate term, swing trade, down to day trade. All the information you need to trade any of those time frames is really on this chart. So, and Troy typed in here, vertical development up, and we might be developing a balance area. And this is something, if you go back and you listen to the DVSA last night, we closed down in here last night, and I said this last night, and I said, we could be developing a balance area. And you will learn. Now, it's important. I don't predict, because Lord knows I have learned the hard way that I can't predict. However, and at the end of even this session, I think you will begin to see where you can anticipate on an if-then basis in real time a couple of probable paths the market is going to take at any given point in time. And that's incredible. That's an incredibly powerful ability to be able to do that. So what you're learning, or what I'm trying to teach you here, is how to view the market, how to understand the market. And if you understand it first, then the process of learning how to trade it begins, and it becomes easier. I'm not going to tell you it's easy, because there are other things involved, but this is the heavy lifting part of learning to trade, is learning the market. And it's a unique place to start to learn to trade, because most people are out there looking for some setup gimmick, and they start trading before they have any clue what's going on with a market and why. And this is why you will find over time, you don't need a bunch of indicators. You just don't need them. I was going to prepare a presentation on indicators tonight, and I just ran out of time. I'm going to do that, though. I don't know where I'll present it within this course, within these 6 or 7 sessions, but I'm going to do that. But the point of this is that if you look at this chart and you're looking at it through the lens of these auction market concepts, everything you need is right here in front of you to answer any question you need answered about what to do and why. The potential risk of any particular scenario, as well as the potential return. So if I go, let me throw this out. If I go short here, right now, where's my stop? It's somewhere up here, right? Is it one tick above here? No, I'm going to put it somewhere up in here. What's my target? Well, my target is down here, right? That's my minimum target. So if I were to go short here, my risk is this, and my potential return is this. Oops. So this is a multiple of this. That's why this methodology has an inherent positive expectancy. Now, note that, this is a 120-minute chart. I don't really care within 2 or 3 ticks. If I'm trading, if I go short here, exactly where I get filled, it just doesn't matter. And that's another thing that's very, very different about this approach to trading. You don't have to, we're not price-based traders. We're trading market condition. Trading market condition gives you a higher expectancy. It gives you a wider range of entry and exit that will create a successful outcome than price-based trading, where guys are trading intraday and they're trading for ticks. And what happens when you're doing that stuff is that you get just pure read to pieces and stuff like this or like this. Or even like this. I mean, this is great trade location, but you've got guys that are trying to trade this with they're going along with a 2-stick stop, and they're stopped out 12 times, and then the market screens higher. So you guys are really learning something that is unique, and it's very different. You have to be different in this business to be successful. Risk disclosure, trading is risky. And it really, really is. I'm not making light of it. Trading is very risky. And one of the reasons that it is so risky is it'd be like if you had a child that was learning to drive, and you drove that child, the child sitting in the passenger seat, and you drove that child out to the interstate, and you said, okay, now you slide over here. Now, here's the ignition, and here's the gas, and here's the brake. I'm going to get on the side of the road here. You drive up there about 10 miles and turn around and come back. Well, that's the equivalent of what people do when they get into trading. They have no idea what they're doing, and they hit the speedway. That's one reason trading is so risky. You guys are avoiding. Okay. We're going to review session 1 briefly. We're going to get into tonight market profile graph analysis, bar chart analysis. We're going to talk about auction market value. We're going to talk about indicators and what they're telling us, but I don't have this prepared. I don't have the charts that I want to do with this. I want to focus on something else. We're going to talk about the development process. We're talking about filtering time frames, and then perhaps most importantly, where and when to trade and where and when not to trade and why. So at the end of the night, it's very important that you understand where and when to trade and where and when not to trade and why. Okay, to review session 1, we established in session 1 that there is an inherent edge when you base your trading plan on auction market principles. And really what you're doing is you're developing a worldview of the market that is unique, and it is that worldview, that bigger picture view, that drives your trading. It drives your analysis and it drives your trading. And what is the single biggest difference between those who become successful traders and those who don't? I'm asking. Sean, let's stipulate something here. My experience with the single biggest difference between the people that I have worked with that have become successful and those who don't. The one, without fail, the people that I have not succeeded in helping are the ones that would not do the simple things, would not do the work. They would not do it, no matter how much money they paid me, and no matter what I asked them to do, or I would plead and beg, and finally they just wouldn't do it. Here's your bonus reminder. If you will record your trades for the next 7 weeks, and I will, and you record them, go back and listen to I want you to put them in a spreadsheet. I want you to annotate the charts. I don't want you to just say, well, let's just talk about some trades I did. No, I'm not going to do that. If you're not going to do the work, I'm not going to work with you. But if you will do the work, I will work with you. And that's the bonus. If you will record your trades, annotate your trades, and send them to me, then I will get in a WebEx session one-on-one with everyone that does that, and we'll go through those trades and discuss them. Sean, you thought that effort was a given? Oh, no. Huh. Yeah, you have no idea. Okay, some things that have to be avoided in trading. Over trading, too much leverage, unrealistic expectations, following the herd, and too much emphasis on comfort. We're going to, once again, throughout this course, you will see things that address these symptoms. These are symptoms of a bigger problem. They're not necessarily the disease themselves. They're almost always symptoms of a bigger problem. Okay, here are some of the things that we suggested that can immediately improve your trading. Trade less, watch more. Start looking at larger degree time frames than the one in front of your nose. Begin to follow more markets, become opportunistic, and you guys have an incredible resource. Some of you are pro members anyway. Some of you are availing yourselves of the pro membership bonus for taking this course for the next 6 weeks. And you have the benefit of sitting in there and listening to Troy. Troy does an incredible, remarkable job of filtering through a bunch of different markets every day and finding trade setups in different markets. And if you notice, those trade setups are the same. I think Troy called me this morning and told me about a Euro setup that, of course, I missed. But whether it's crude or the Euro or the S&P, there are a number of different markets, and all of those markets have the same setup. And that's something you'll see tonight also. So, I'm going to slowly sort of brainwash you over the next 7 weeks into beginning to realize that you don't have to be a one-trick pony. There is a school of thought that says, well, you just need to learn how to trade one market at a time because it's too confusing to trade more than one market. That's nonsense. Anybody that says that doesn't understand how markets work. You don't have to trade all of them, but you certainly should trade more than just one in one time frame. Now, the other thing that I suggested that you do is to start writing down the reasons for every trade you take, why you entered, why you exited, and specifically, if you're using oscillators or tools or fib stuff, write down, say, hey, it hit the 38.2% retracement today, and I went long and I got stopped out. It didn't work. So make a note of that. Maybe the 38.2% retracement thing doesn't work. Find out. Maybe it does. You don't know unless you record your trade. Okay, we're going to get into tonight now, really getting into the details of putting the auction market worldview, putting the tools that we use into this auction market worldview. And the good news is that there are really only 2 tools. There's the profile graph and there's a bar chart. Now, I'll get into volume at another point in time, but the profile graph is a dimensional view of volume. It's volume on the horizontal scale. A bar chart has volume on the vertical scale, and we will cover those things. So the profile graph is basically a bar chart, but the vertical range of each bar is denoted by a letter. Profile charts have some chronological standard. They can be 5 minutes, 30, daily, weekly, monthly, yearly, just as a bar chart will. Profile charts were specifically designed to provide a view of trade activity on the horizontal scale. It is an ingenious way of replicating volume. And basically what it replicated and what it still replicates in the manner that we use it is transaction activity. It's a transaction at a point in time. And the legacy, that the time at which the market profile concept was posited, it's important to understand that because it was posited based on what was available at that time, and even more importantly, what was not available at that time. And that's why it's some of these legacy concepts, if they're sort of, the terminology is sort of head scratching, a lot of it made more sense back in the day when you didn't have real-time volume, and there was a whole vocabulary that built up around the market profile graph that was sort of a legacy. And the profile graph, its genesis was from the floor and the floor activity. And remember, to remind you, the floor, when the profile graph, when the market profile concept was first posited by Peter Stettlemyre, the floor ruled the world. In terms of the markets, everything went through the floor. The floor traders had a tremendous edge, not just not having to pay the bid-ask spread, which itself is a huge edge, believe me, but they were the first to see the order flow coming into the pit, who it was from, what they were doing, how much they were doing it, and the floor had that information before anyone else. You are at a tremendous disadvantage, and you, as an off-floor trader, a tremendous disadvantage. You really didn't know what was going on until it was too late to act on it in anything resembling a short-term time frame. Now, the irony is that now the floor is sort of a relic. Some of the New York markets still have an active floor with a lot of flow through there, but the Chicago markets, I don't know about the grains, but certainly the S&P, it's for show now, for all intents and purposes. There is so much trading that goes around the floor and into the mini and electronically, even in the big contract, that the floor is as reactive now as an off-floor trader, and in sometimes even more so. So the information flow has dramatically shifted away from the floor having this huge advantage to, quite frankly, the off-floor trader having a bigger advantage. Sadly, the biggest advantage an off-floor trader has is missed on most off-floor traders, and that is the ability to sit there and do nothing. Most of the time, what you should be doing as a screen-based trader is nothing. Even if you are a day trader, most of the time, what you should be doing is nothing. You're either out of it, you're not in a trade, and you're looking for the opportunity that's defined, and we're going to define that tonight. Or you're in a trade, and you're waiting to either get stopped out or have your target hit. And, I'm oversimplifying that a little bit. You have the opportunity to manage a trade once you're in it, even if it doesn't stop you out and it hasn't hit your target yet. There are things that are advisable to do when you're in a trade. But most of the time, as an off-floor trader, screen-based trader, what you should be doing is nothing. Okay, I'm not going to get into a lot of the detail minutia of the profile graph, except to cover the basics. These letters are TPOs, and what TPO stood for, according to Stettlemyre, time price opportunity. And this is typical Stettlemyre, coming up with sort of a head-scratching, abstruse definition of something that's relatively simple. Leave it to Don Jones, who, again, he's a physicist. He's literally a scientist. To simplify things, that price occurred. So I really prefer that price occurred because that's what it is. This indicates that a price occurred at this level in this time frame. Now, understand that in a 30-minute profile, each rotation, each vertical bar, each slot is 30 minutes. You will only have one print in that 30-minute period, no matter how many times price passes above and below that particular price or prints at that price. Now, each of these vertical lines can be, it's a bar chart. You can have a 30-minute chart, you can have a 30-minute, you can have a 60-minute, 5-minute, daily, weekly, monthly, etc. So the chronological protocols can change, and you see me frequently change views to get a view of the auction. And that all I'm interested in the profile graph is getting the best view of the auction at this point in time. You'll see me use weekly, daily, monthly. You'll see me take parts of days and combine them into the previous day. And I'll show you a little tip on what I'm doing and how I'm doing it. There's no big mystery to it. There's no one hard and fast rule. There's a very, very simple technique that you can use. But it all gets, it all revolves around understanding what the auction process is doing. The auction process is referring to value. What is the market doing in terms of value? Is it accepting value here, or is the condition of value at this point in time changing? Those are the questions you're always asking, and that's what the profile graph was designed to do. It wasn't designed as a trading tool, some sort of rote, if it trades 3 ticks into the value area, you sell it and all this nonsense. That's not how it was designed, or what it was designed for. The profile graph was, I still don't think it's appreciated how it was really a complete paradigm shift. Actually, that paradigm shift is, I'm still waiting for it to kick in. And that's the good news for you guys yet. People still don't get it. People still do not get what, the real incredible value of the worldview of auction market concepts. They're still trading the profile graph. But if you go back and you really read Stellemeyer's work and his early stuff, and even now, and sort of read between the lines, he's talking about an auction and he's talking about a development process. And his desire was to get people to understand that they had to be trading a market condition, and that market condition was tradable information. It could be traded different ways, but not only was it tradable information, it was ultimately a necessity to trade successfully to understand market condition and what a market was doing. Okay, this is the S&P chart. Now this is a yearly chart. In other words, each one of these auctions, each one of these profile units is 1 year of trading. Now there are a couple of things, subtle things to note here. An auction is not always this nice, neat Gaussian shape where we have, 3 clear, you have a third standard deviation up here, a third standard deviation down here, and then your high volume node is at the mode of the distribution. So it has the general shape of your typical the bell curve of a typical standard distribution, but you're missing the point if that's what you're assuming is always going to occur. Not only are you missing the point, but you will be thoroughly confused and even worse, lose a lot of money if you're assuming that all auctions are going to end up in this nice Gaussian shape. They're not going to. You can see somewhat the regressive nature of price. And it's the regressive nature in price in a given time frame that creates this bell shape where you have basically unfair highs, unfair lows at an area of greatest value. The key point to the fact that you have that price is regressive is that it's regressive around value, but value is a moving target. Value changes. So if you're sitting there assuming this is always going to be value, you're going to lose a lot of money. You have to be, that's why you've got to understand the concept of value and the migration of value, and when value is transitioning, when the present perception of value begins to change, you have to recognize that and change with it. All right, here's quarterly. I'm just going down in time frames, and this is an exercise to show you, to continue to reinforce the idea of what a remarkably robust methodology this is across all time frames and all markets. So each one of these is a quarter. Each individual letter, each slot is a week. And then here we have individual months, where each letter is a day. And this again is the S&P. And this is live cattle. So what does the S&P and live cattle have in common? They're both traded in an auction market. Therefore, you can trade live cattle and the S&P Mini on a 5-minute chart exactly the same way. Now, I don't suggest you trade live cattle on a 5-minute chart, but you can certainly trade live cattle on a 30-minute chart. And at times, you can actually find 5-minute setups in things like live cattle and lean hogs and things like that. We've done this, and we'll do it in the room periodically. The grains were an example. I could take all night. I could walk you through every single market that I have access to and show you these auctions that are all the same shape. And the reason they're the same shape is because the auction process is the same regardless of the asset or regardless of the time frame.